I am having audio issues and I have recorded this section more times than I care to count, so I'm going to keep my fingers crossed, hope that all is going well, and we're going to buzz through intangibles. We have two kinds of intangibles. We have Section 197 intangibles and non-197 intangibles. So we'll talk first about what Section 197 intangibles are. And these are intangible assets. So they don't have a physical character to them. They're not a vehicle. They're not a piece of factory equipment, but they're assets that we purchase as part of the acquisition of another company. So if we go out, we buy a business as opposed to starting it from scratch, there are going to be assets that have value beyond the physical assets of the company. And those are generally goodwill, going concern, know-how, covenant not to compete, franchise agreements, trademarks, things like that. And so just as an example, if the phone number that comes into my office here has been owned by me for more than a decade, was owned by the attorney before me for 10 or 15, probably 15 or 20 years, and was owned by the attorney before him for I don't know how many decades. Each attorney in the chain of ownership of this telephone number practiced bankruptcy law. And quite likely, anyone who had been represented by an attorney attached to that phone number over the years might potentially give that number out to somebody and say, hey, go use my bankruptcy attorney. Now, they will call, they will get me. I may not have been the original bankruptcy lawyer, but they probably don't care as long as I can make their credit cards go away. That's their primary interest. And so the value, I had to spend zero advertising dollars to bring that client in. And so the goodwill that's associated with that phone number will continue to generate revenue for me without me having to do any advertising work for decades to come. And similarly, going concern value assumes that the business that we buy is more than the value of its assets, that it has generated some recognition in the community, and it will continue to operate going forward as opposed to something that we're going to liquidate. So when we have these Section 197 intangibles, how do we treat those? Well, we don't depreciate intangibles. We do what's called amortization, which is similar to depreciation, except with these 197 intangibles, we don't care what their useful life is. What we're going to do is we're going to divide that value over a 15-year period and use a straight line method to amortize that goodwill, or well, I say goodwill, but it could be a franchise trademark. And what we don't do, however, is have to use the mid-quarter convention or the half-year convention. We will amortize these things from the month we acquired them going forward through the 15-year period. Now we got these non-Section 197 intangibles. What are we going to do with those? Well, those are intangibles that we've acquired separately from the acquisition of the business itself. It could be a patent that we purchased from someone, for example, and these will get amortized over their remaining useful life. So unlike the 197 intangibles where we've got this fixed 15-year period, with the non-197 intangibles, those will be we will have to establish the remaining useful life and amortize over that period. Now, there are a subset of 197 intangibles that are not amortizable. If we have computer software that we have produced and it is ready for sale to the public, that is intangible, but it's really inventory. We don't depreciate our physical inventory, nor would we amortize our intangible inventory of product that we would sell. If we've self-created some intangible assets, not going to amortize those as well. Here's our example. So in May 2019, Fiona Ware purchased a small artisan textile company for $980,000. Part of the purchase price was $54,000, and that was allocated to goodwill. They made that determination right up front in the buy-sell agreement, and it made their accountant oh so happy because it took the guesswork out of it for the accountant. So how much goodwill does Fiona Ware get to amortize in 2019 and 2020? Well, this was 197. It's an acquisition. We're talking about 15 years, except in year one, she only owned it for 8 months of year one. So we've got to first take that 54,000 and divide that over the 15 years, and that gets us to $3,600 per year. Now we need to take the first year and allocate it toward the portion of the year that she actually owned the business, which was only 8 months of year one. So that reduces the year one to $2,400, and then she goes $3,600 a year from then on. Now we're going to talk about gains and losses, and specifically 1231 gains and losses. So what is a 1231 asset? They're not capital assets. They are depreciable or real property used in a trade or business. Could be timber, coal. I have never seen any of that in my real life, although livestock I've certainly seen, as well as unharvested crops on land used in the trade or business. My dad was in the avocado growing business for a while and had 5 acres of avocados, and guess who did his taxes? So we do not apply Section 1231 treatment on any property that we've held less than a year, for 1 year, or anything that is inventory and property that we will be selling to customers, copyrights, paintings, things of that nature. And 1231 assets get special tax treatment when we dispose of them. And they get treated as long-term capital gains, although the losses in some cases get deducted as ordinary losses. And so the way that this works, there is some netting rules. If Section 1231 gains exceed 1231 losses, then the excess is a capital gain, and that gets treated at the more favorable capital gains rate. However, if the Section 1231 losses exceed the gains, then all gains get treated as ordinary income, so you don't get the favorable tax treatment, and all losses get fully deductible as ordinary losses. Then we get to this nasty little thing called depreciation recapture. So over the time period that, let's say you're a landlord and you've been renting out this property which you have been dutifully depreciating, and maybe you've owned it for 20 years, and you were depreciating it over the 27.5 years, and then you decide to sell it. There is a recapture that gets applied to the depreciation. Basically, when you took depreciation on that property, that essentially reduced your taxable income that year. Well, when they go to sell it, this unrecaptured depreciation, at least in real estate, is 25% recapture. If it is other kinds of personal property, it's whatever your taxable rate is for your other income taxes, but 25% on real estate. And this basically just breaks it down a little further as to what is considered 1245, which is, again, depreciable tangible personal property or amortizable intangible personal property. Basically, this is your non-real estate depreciable or amortizable property, although you wouldn't amortize real estate. But anyway, so basically what they're going to do is they're going to look at that depreciation that we took over all the years that we've owned this asset, and that at the point that we sell it, the amount of the sales price that would have been attributable to that depreciation that we took won't get taxed at the capital gains rate, which is more favorable. No, it will, if it is 1245 property, gets taxed at the ordinary somebody's ordinary income tax. Let's talk about an example here. On April 1, Francesca sells depreciable personal property used in her business. She purchased the property 4 years ago for $60,000. Francesca claimed depreciation on the property of $25,000 and sold the property for $50,000. What is her Section 1245 recapture? Well, if you have decided she sold it at a loss, that would be wrong, because despite the fact that she sold it at bought it at 60 and sold it at 50, she had an adjusted basis of 35,000. We take her original cost, we subtract the accumulated depreciation, and that gets us to her adjusted basis. And so she sold the property at more than her adjusted basis. So we're going to look at what the recomputed basis is. And if we go back, well, I guess I'll go forward. Her recomputed basis is her adjusted basis. Actually, no, I will keep that. Okay, her adjusted basis, which is her original cost minus her depreciation. And then, so we take that adjusted basis and we add in the potential of the depreciation recapture, which is the amount of depreciation we took. That gets us to our recomputed basis. Now we compare that and take the lesser of either the recomputed basis or the realized gain. So her realized gain is she got $50,000 for it, but we subtract her adjusted basis for a $15,000 gain. So she's going to get the lesser, which is the $15,000, which will be subject to tax at her ordinary income rate. Now let's look at an example as it Section 1250 relates to depreciable real property other than what's identified in 1245. If it was depreciated on anything other than straight line. But because straight line has been in place for so long, you're probably not going to run into this anymore. But if we have depreciable real estate that we have sold, the personal property gets treated at the ordinary income rate when we recapture it. If it's real estate, the calculation is the same. However, it gets treated in one of two ways from an actual tax perspective, which is either it's a flat 25% tax if the person's ordinary tax rate is 25% or higher. If the person's tax rate is below 25%, then the recapture on real estate gets treated at their ordinary tax rate. So virtually anytime somebody sells rental property, you're at a gain anyway, you're going to see this recapture situation. We haven't talked about net investment income tax. Oh, I guess maybe we did. So if they are subject to net investment income tax, there is also 3%, 3.8% over that. So it increases that flat 25% up to 28.8%. Let's look at a real estate example. So we've got Ella, who bought some property for $7 million way back in the day, sold it for $8,500,000. Yay, Ella. She used the straight line depreciation on the property, and she had taken depreciation in the amount of $6,100,000. So her adjusted basis on the property, her cost minus her accumulated depreciation, is $900,000, and she sold it for $8,500,000. Yes, yeah. Ella's in the 32% tax bracket for ordinary income. She's not subject to the additional 3.8%, so we don't have to worry about that. So any gain is going to be capped at the 25% because her ordinary rate is above that. So let's look at, well, and any recapture is hopefully what I said. All right, so what's Ella's realized gain? Her realized gain, the $8,500,000 less her adjusted basis, is $7,600,000. And okay, 6,100 of that gain is attributable to depreciation, and it gets taxed at 25%. The remaining $1,500,000, so the difference between the recaptured amount and her total realized gain, does get the 15% long-term more favorable capital gains rate. So, you know, overall, not a terrible deal for Ella because she's still in the 32% tax bracket. So if she was in the 32% tax bracket while this property was being depreciated, then she was saving on her income at a 32% tax rate over all those years, whereas it's only being recaptured at 25%, and then she gets the gain on the 15%. So not all bad news for Ella. And I'm going to stop here and go on to the next video to talk about business casualty gains and losses.